Good afternoon or good morning or good evening, depending on whenever you're watching this. Welcome to another episode of the Everyday Trader. Before we get too far, like and subscribe, comments, we appreciate it. This is Eric Hale with Trader Oasis, and I'm joined by my partner, Greg Jensen.
It is good to be with you, everyone. Eric, it was good to be with you in Florida last week. That was actually kind of fun doing a live one together.
That was fun. I don't think that one came out as good as I had hoped. Some people said some audio issues, and it was really exciting. And we actually didn't record after we had the really interesting discussions that happened poolside at the rooftop bar. After everything wrapped up, we had some very deep and thoughtful sort of discussions with.
That's a very nice way of saying that. Deep and thoughtful. It was one of the most heated arguments I've ever seen a Fed member have, to be honest. It was pretty intense.
Yeah. I can sense the frustration in Chris Waller pretty clearly that, to be frank, and I don't think he'd mind this because we talked about, I actually remember what I said under Chatham House rules, what he said.
Yeah. Yeah.
Let's just say it was R-rated. His response was Chatham House rules. I'll tell you what I think. So he doesn't need Chatham House. I think he wants media to communicate his message. And the Fed's job is to get inflation under control, and inflation is not under control. I'm just dumbfounded by the headlines that I read. I was telling Greg before we get started, I saw a headline that the Fed should cut this coming. People are disconnected from what the Fed's job is not to make the market go higher. The Fed's job is
price stability.
It is price stability. I almost said it's not unemployment, and it's not your job because it is. It's actually, there's a dual mandate from the Federal Reserve, and that is to keep aside the responsibility for managing the banking sector. But as far as economic policy, the part that Waller's part of, he has two jobs. One is to get inflation back to 2%, to keep inflation moderate, and to get maximum employment. And we have incredibly high employment. And he made the comment with regards to recession that we've never had a recession with unemployment under 6%. Now, unemployment tends to take off like pretty dramatically. It could go from 4 to 6 or 8 or 10 or 12 in the matter of a few months. But right now, labor is very, very strong, and it's giving plenty of cover for the Fed to be raising rates. Inflation is not under control. Today, we got the PCE number, right?
Yeah, and that's not to say, before we talk about PCE, and that's not to say that we aren't seeing some companies out there that are preemptively looking at, reducing headcount at their staffs because they see uncertainty down the road. And so you're seeing especially a lot of big tech. Now there's, the question I still ask with a lot of the layoffs that have happened inside of big tech go back to a conversation. I know we talked about this several months ago in one of these recordings that, Twitter is currently operating at about 20% of its headcount that it had before Elon Musk bought the company. And by all means that I use Twitter, it looks and feels the same. In fact, it looks and feels better pre-Elon. I know some people might disagree with me, but the company's functioning with a fifth of their staff. And so I wonder if a lot of other companies in Silicon Valley have looked at what happened there and said, maybe we have too many people too. And could we improve our bottom line by laying some people off? And, we did see a couple of those big earnings announcements this week from Silicon Valley tech companies that, man, a couple of them were massive reactions. I guess Microsoft isn't Silicon Valley. They probably, are mad at me for saying that they're Silicon Valley. They're Seattle. But Meta is definitely a Silicon Valley based tech company.
Well, I'll
Anyway,
take the other side of that. I mean, labor, I think, is really strong. We saw weekly unemployment claims this week, which are down 16,000 below expected. I mean, we saw
no, I'm not going to let me step back because I don't want to paint the picture that I was saying that the job market is weak. We're seeing a little bit of it, but I still agree with you. I think the job strength is still really strong. I just think there's a few companies that are following the path of Twitter saying we employ too many people, but I guarantee you a lot of those layoffs that have happened in Silicon Valley, those people are reemployed again. There's still a lot of job openings across the country.
yeah,
So
I mean, IT is one of those places that people are able to work from home. And so that's, my wife's an HR manager, and when she sees somebody that's IT and unemployed, she says that person doesn't want a job, as they have a real hard time still filling positions there. We saw two data points this week with regards to labor. One is this unemployment claims, which is stepping down. That's a sign of strength. The other was in the personal income and outlays report. If we looked at the personal income and disposable income or is it the PCE, not the PCE, the ECI,
the ECI, yeah, the employment cost index.
The employment cost index was up. I have another report, I think, of that someplace. Bank of America had a report out that wage inflation's going up. This surprised everybody. So wages is definitely a component. And now they're showing it here in this graph that the ECI is rolling over, but it's still high. So people have jobs and people are making good money. You can see that screen, right? You see that?
Now I can.
Okay, there you go. This is from Bank of America report issued today, employment cost index. You can see that it's high. So this was a surprise, and that's another data point that the labor market is strong. And this is the unemployment claims coming down here. This was at 223 that we had on Thursday. Now here's the COVID spike, so it's really hard to look at it. Or I guess it was 236. I'm sorry, on Friday, but still historically a very low number. Signs that the labor market's really strong, and the Fed. I mean, I don't think Waller said it, but I understood it from his the fact that labor's so good, that the job market is so good. They can feel comfortable raising rates and recognizing that some people are gonna lose their jobs, and it's cold-hearted, but that's the fact, is that we're gonna see people who are gonna get displaced here as the Fed continues to increase wages. And I think the Fed isn't going to panic until they see a number that's in the high fives.
Yeah, so I agree with that.
9%, 6%, then I think the Fed is going to look. Waller said unequivocally in as many words, is that we're going to raise rates until inflation starts to come down. And when we're done, we're done. And he said we'd rather overshoot and correct if we need to. The market just isn't hearing that message, and just understanding how the Fed works. So you've got the 6 members of the governors, and then what is there, 6 other people who vote?
They rotate the presidents of the different the different geographies, the different regional banks.
So the question of a dissent came up. That was a really interesting discussion from, was it Leland Miller? I think
Leland Miller, I think, asked him
brought that up. Now this isn't a casual sitting around the table conversation, and Waller he's open book. I mean, he said screw Chatham House rules. So I mean, I don't think we're throwing anything out there that's inappropriate. But we talked about dissent. Would a somebody on the board of governors dissent? And he said absolutely not. That would be a tremendous disrespect to the Fed president, to Jerome Powell. And the reason is because that committee works together to have sort of that core, the Fed governors, the 6 Fed governors, should have a consistent vote. They're all going to vote the same. And his point is that if we have an issue, we shouldn't express it through a dissent. we should talk about it. And he threw out some anecdotal stories about people who would say they're okay and then throw out a dissenting vote. Now, presidents, regional presidents, so the presidents from the different banks who vote from St. Louis or Chicago or San Francisco, I forget who's on the queue to vote this year. Seeing a dissent from a Fed president is not the same as a board governor, but the governors are going to be in alignment. And just based on what you hear from that, they're all, I don't think any question, raising rates is what they're going to do. And they're going to continue to do it until we see the numbers come down.
And if you look at the overall earnings so far that we've seen this quarter, we are seeing an earnings decline. It is in some companies. And I think the overall S&P earnings are declining somewhat, but it is not drastic. I mean, there were, like I mentioned before, a couple just blowout earnings numbers this week with Meta, with Microsoft. And, if you look at the performance of a lot of companies this year in the S&P 500, it's really concentrated. Stat was thrown out earlier today by Unusual Whales on Twitter that, he stated that the top 10 companies in the S&P 500 are accountable or responsible for 86% of the index's returns this year. And so Apple, Microsoft, Amazon, NVIDIA, Google, Berkshire Hathaway, Meta, ExxonMobil, United Healthcare, and Tesla. Those are, and that, I know that was only 9. It's because Google actually is 2 of them with their A shares and their B shares. But we're really being driven by mega cap tech again, and mega cap, companies like Berkshire Hathaway and ExxonMobil all-time high today after what's going on with their earnings as well, had blowout earnings. So earnings are still pretty good. Employment's really good. Housing actually seems to have stabilized a little bit. So tell me why the Fed is going to cut next, not next week. I think they're raising next week, but even by the end of the year, there's no reason for the Fed to cut, at least not yet. Maybe that comes in the second half of the year, but right now, inflation's not under control. And so I agree with what you said and what Waller said last week. I think the Fed is going to stick to their guns, and there's a disconnect as to what the market is pricing in right now. I think they're starting to price in the idea that we're going to have rate cuts in the second half of the year. And I just don't think I don't think it's realistic.
Well, second half of the year, we've talked about that earlier, that there are some warnings, there's some dark clouds on the horizon that we can see if we look at the volatility term structure, that there's something out there. I think a big part of what happened this week, and I don't think it's getting enough credit, is the fact that tax receipts came in this week that were well above forecast. And what that means is that this debt ceiling limit that we've got basically got extended out another month to 6 weeks. So it's looking like July, potentially end of July, that before we reach a point where we could potentially shut down. So there's intermediate steps that can happen between now and then. Goldman Sachs did a nice report looking at this, and it was Nick Timmerose talked about it as well in the Wall Street Journal this week. But I think that the debt ceiling thing is what's got the market really spooked. So it's and I think seeing that relief that we got this week, I think that explains why we've had a rally this week.
Well, that makes sense. The debt ceiling in the past has always been resolved. We hit it. It's made to be hit. I know we've said this before. We've talked about it. We're also in the most divided situation that we've ever been as a country politically. And
I don't know about that. I think in the past, there were people who were killing each other, literally. Of course, that was not in our lifetimes. But
no, that's okay. All right. Maybe in the 19th century, the most divided we've been. I guess
No,
that's true.
I was having
Civil War.
I
I
was
guess
having this conversation with somebody, and I was saying that wow, people are so divisive and they hate each other, and the anger. I've never, so much. And they said, well, there was a period of time when people were killing each other, literally killing each other over political beliefs in this country. So we've had that in the past. I think overall things are good. It's just we tend to focus on what's in front of us. I think overall things are great.
Well,
But it is interesting to look at where we're heading in the market here. There's another thing, and I think really interesting commentary that I don't think we've shared with this community, but something to put on everybody's radar was McVain's chief economist, Michael Drury. Maybe you want to share what Michael shared with us over that rooftop
yeah, no, one of the
late night
things that,
session sitting next to a pool.
yeah, one of the things that we talked about as well is, we saw the Fed stepping on the brakes last year, and then all of a sudden we got an influx of cash that kind of kept things afloat for a while. And he pointed out the fact that that was the increase in Social Security that happened. And we've got a similar type of situation that is on the horizon that not a lot of people are, I think, pricing into the idea of the impact it could have on the economy. And that is the massive amount of student loan debt that has to start being repaid in August. They've all been delayed or furloughed of having to pay those student loans back. And now that's going to have to start happening. I think the number was 1.4 trillion. That's the number that sticks in my head. I don't remember the exact number. I know it's in the trillions, one something trillion, 1.4, 1.8. So what's going to happen is, these kids that are graduated from college and making money and they've been doing well are not used to that $500 a month payment that's coming. And that's the average of what that payment's going to be. For some people, it'll be less than that. Some people will be more than that. But the average payment that's going to have to start getting paid on a per household basis is $500 a month. And that's going to start in August. In August, they'll have the money to pay it. In September, they'll have the money to pay it. October rolls around and they'll be like, this really sucks. We didn't have to, our budgets, we're not staying inside of our budget anymore. And they still make the October payment. November rolls around and all of a sudden, a lot of households are looking at, we may not be able to afford the type of Christmas that we thought we were going to have. And so really the latter half of this year is when that additional money that's going back to student loan payments and is not going to Target or Costco or out to eat is being spent in student loan payments. That's going to contract the growth. That's going to contract GDP here in the economy, and very likely could be what pushes us into recession in the first quarter of 2024. So
Yeah, that was very interesting. I heard the number. I don't know if this was just off the cuff, but something on the order of an average. I thought I heard the average payment is 500, or at least that was mentioned in the conversation. And I think your average person, if you were used to making a $500 a month payment and then COVID happened and then you get a holiday, that gap tends to get filled up with other spending. And so certainly pulling another $500 out of people spending, it has to have an impact. It could be this trickle down thing, and the timing is going to work out right. It's going to hit us hard fourth quarter when people make one or two payments, and then they start realizing that it's going to affect Christmas and holidays, and then start affecting retail sales. And so Drury's predicting a recession in 2024. His logic seems to make a lot of sense.
Well, we get some fireworks next week. We'll get to see what the Fed says. We get earnings from you and I's favorite company. At least I'm assuming Apple's still your favorite company. Do you like Tesla more than Apple?
I think Apple's fairly priced where it is. I just entered a bearish trade today that I shared with people. I don't know if you saw that.
I did.
Yeah. So it's a bearish but a Vega positive trade. So what that means is that it'll make money with an increase in implied volatility. I expect implied volatility to still go up. So this is a trade that leverages several different trends. It's bearish, theta positive, and Vega positive. So it makes money if the stock is stagnant or bearish, it makes money with time going by. It makes money with volatility increasing, which is what I expect to happen, which sort of, maybe I'm speaking Greek to some of you if I talk delta, theta, and vega, with that. We want to try and help you folks understand volatility a little bit better. And we were planning on doing some stuff today. And we realized it's probably much bigger than just one short little snippet. There's probably a lot more to it. There's a lot of questions that are out there about volatility. What is it? And how do you measure it? And how do you leverage it? How do you trade it? What does it tell you? And there's a lot there. So maybe we need to break it down into chunks and address a couple issues. At a time. But I think when you really understand implied volatility, you recognize that there's another dimension to option pricing that most people don't pay attention to because they don't understand it. And in terms of being able to prognosticate changes, if I gave you the choice of predicting, so there's three big things that affect the price of options. So the stock price matters. That's a big one. Time matters, and implied volatility matters. In terms of ease of predicting those three, time is the easiest. So time's going to move forward. We don't even need to say that. In terms of the other two, predicting what's going to happen with volatility or what's going to happen with the stock price, predicting what's going to happen with volatility is by far easier than predicting and you can be right probably 75% of the time, maybe even more. And most people don't even look at this dimension when they're trading options. They're looking solely at stock price. And I think the idea is you want to try and get all three of them working together and then having a plan rather than just trade one. Most people trade only on or focus only on stock price. Implied volatility and time matter too.
Yeah, I'd much rather trade volatility and time. Much easier to manage. Your success rate on your trading goes up much more if you focus your trades on that instead of trying to determine, okay, well, I think Amazon's going to beat earnings, so I'm going to roll the dice and go buy call options and in front of an earnings event. And not only can you sometimes be right about the direction, but if you're wrong on, time or volatility, you can actually end up still losing money on an options trade, even though you're right on you thought it was going to go bullish, you bought a call, you could still lose money. We'll get into that next week. I actually think we'll start recording these ideas on volatility next week, and maybe do a series of recordings and bundle them together in a playlist here on our channel. So look forward for that for the next few weeks. We'll do some recordings on volatility. Should be fun.
You mentioned one of my hot stove moments. I mean, everybody's touched a hot stove at one point in their life. You probably have a visceral response when you think about that. One of my hot stove moments was buying calls on Apple the day before they announced the iPhone, and the stock went up $6, like 6%, 6.5%, I think. And my calls lost money. So, like, wait a minute, I have long calls. The stock made a huge move up. How do you lose money? And it was volatility crush, which is something I did. That's a painful lesson, but that's where I learned about volatility crush. That trade ended up I lost like $2,400 on the trade when I got the direction right. And had I factored what would happen with implied volatility into the trade, I could have made money. I should have made money on that. Knowing what I know now, I tend to be pretty good at trading events like that. But it was painful to learn that lesson.
We'll share some of that stuff with you guys next week as we start these recordings. So it's good to be back with you. We'll anything else you want to throw in for we're done
just
for the day?
stay vigilant. Earnings is coming up, so trying to figure out what to do around earnings. Sometimes the right trade is not trading and waiting till the earnings event. I'm a big fan of collar trading over earnings. We've seen some pretty mixed stuff happen this week, and some companies that have had some great earnings and the stock moved a little bit differently than we anticipated. Amazon was an example. Amazon was fantastic, but of course the AWS, the web services side of the business, forecasting lower in the future, had ramifications beyond Amazon. Meta, glad to see them back making profits. So earnings is important to factor in, and then also the Fed meeting next Wednesday is going to be a big deal. Right now there's an 85% probability of a quarter point basis hike. That's ridiculous. I think it should be 100%. There's no question. Yeah, I would bet my house that there's a rate increase. I mean, I would take a big bet that we raise next week, especially given the data we saw today. The market responded quite nicely today to what should have been, I think, probably
Yeah.
sentiment. So that makes me wonder if the market isn't necessarily focused on the Fed as much as it is other things like debt ceiling and earnings. I think that maybe that's the message I got today. Anyways.
Okay, good to be with you. Thanks for joining us today, folks. Have a good rest of your trading day. See you all. We'll see you all at the next one.